Thank you for joining us. The following presentation is from a webinar titled Mitigating Taxes for Contractors, Section 460 Application, originally produced on November 14th, 2013. The presenters are Lisa White and Chris Kerr with McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for information about our future events and upcoming webinars.
Thanks, Reed. And thank you all for joining us for the webinar on mitigating taxes for contractors. What we're planning on doing today is kind of going over some of the section of 460, some of the applications that apply to small contractors, large contractors, look-back applications. And you'll see a little bit further, we have a detailed agenda also that'll kind of go into detail as far as what we're going to cover. What we're looking at is with the environment that's coming that we see on the horizon as far as the tax environment. We want to make sure that you all are aware of applications, methods, planning opportunities that might exist that aren't as apparent and aren't kind of new on the scene. They are in existence, but it may be things that you just may not be aware of. I do want to indicate in this that there are going to be some scope limitations within this webinar. We're going to be going into a lot of methods, and one of the areas that we're not going to touch on is going to be the AMT applications or implications of those methods, just because of the time constraints for the webinar itself. Also, when we get into the look back section, we're not going to be going into the actual calculation of the look back. Just because it's such an intensive calculation and such a complicated calculation, just in the essence of time. But we may be doing those at a later time, so keep looking on our website. First, just a little bit about myself. My name is Lisa White. I am a senior manager with the tax department. My areas of specialization are construction and real estate. I joined M&A in 2008, coming to them from a firm in Nashville that specialized in construction. And I've been doing this for now over a decade. And with me today is Chris Kerr. He's a staff accountant in our tax department also, and his area of specialization is also real estate and construction.
Thanks, Lisa. Let's also talk about McKonly Asbury for a second. We are a full audit, tax, and risk management firm located in central Pennsylvania. Nice presence in the Harrisburg and Lancaster areas. We serve a variety of clients, as you can see on the slide, from construction to manufacturing, real estate, retail. Nice broad spectrum going on there. We do have special capabilities in real estate and construction industries, and we've been named a best places to work and a best accounting firm in the U.S.
Well, as mentioned before, here is the detailed agenda for today's webinar. First, we're going to be going into the Section 460, looking at the definition, when it applies, who it applies to. Then we'll look at the small contractor applications. This will be the methods that can be used if you do qualify as a small contractor. From there, we'll lead into the large contractor applications. And again, this is the percentage of completion mainly, and some applications that can be used if you are deemed to be a large contractor. And then lastly, it will be the look back. And as mentioned before, this will be more of theory than it will be in the actual calculation. All right, so jumping right into this, the first thing we're going to look at is the IRC Section 460. And for those of you who are out there that aren't accountants, just know this is the only code section we're going to throw out. Everything else will be words, not numbers. So when looking at Section 460, what exactly is it? This is the section of the Internal Revenue Code that regulates long-term contracts. Now, the definition of a long-term contract is a little bit different for the IRS than what it is for the general consensus. Typically, when we think about long-term, you think of it in a period of about 12 months or greater than 12 months would be what would define something as being long-term. In this case, you're looking at tax periods. If you span over more than one tax period, then you have a long-term contract. So the example that the service actually provides is that if you have a contract that you start in December and you finish it in January and you're a calendar year taxpayer, you have a long-term contract. The other thing that they go into is to define what does not qualify as a long-term contract, even though you may have or be involved in an industry that is directly related to construction. And this would be like architects, engineers, construction management even. If it is a service-related industry and what you're providing is just services, that you're not actually doing the construction or the building or the improvement on tangible property, then what you're doing is not deemed to be construction. So you're not eligible for or required to follow the rules of IRC Section 460, again, depending on how you look at it. Then the way the code is written also is it gives an absolute, which means it says that if you have a long-term contract, you must use and follow the rules under 460, but then it provides exemptions. And it says, okay, you have to do it this way except for this and this and this and this. And that's what the last two items are. We have the two exemptions. The first one is the small construction contracts, and the second one is the home construction contracts. And both of these are specifically defined and identified as being exempt from IRC Section 460. And now Chris is going to go into more details for the small construction contract exemption.
Lisa, is there any time where another professional services company, such as engineering or construction management, could or is required to use long-term contract recognition?
There is. That's a great question. When there are related party activities, then there are cases where a service industry could use percentage of completion. But just know if there are no related party activities, then you will not be able to.
As Lisa mentioned, there are two exceptions to long-term contract recognition. The first one we're going to look at is the small contractor contract exception. And for this one, it is a two-pronged test. First test is for your annual gross receipts for the 3 prior tax years. This has to fall under a $10 million threshold. And if it does fall under that threshold, then on a contract-by-contract basis, you look at it, and the contract has to be completed within a 2-year period. And in this case, you would qualify for the exception, and you would not be required to use the rules under IRC Section 460. For the first test, for the $10 million revenue threshold test, there is a common misconception about this, that the $10 million threshold is just for the entity that has the contract. And this isn't quite correct. Because for the 10 million test, you also have to include all trades or businesses under common control, which means that one entity or individual owns 50% or more of each entity. And you have to look at all members of a controlled group of corporations of which the taxpayer is a member. And this is when 2 or more corporations have stock that is substantially held by 5 or fewer persons. And in this case, you would pull in all construction revenues from these companies. And the third test here is for attribution rules, and this is when ownership is held between 50% and 5%. And in this case, you would bring in the pro rata share of the construction-related income from that entity. So for example, if you own 5% of another company, their gross revenues, you would recognize 5% of those to see if you meet the $10 million threshold.
Hey, Chris. And so in this case, do you see often that a small contract actually blows the $10 million test, or how easily is it to blow the $10 million test through these rules?
It's actually pretty easy, and we see it fairly often. And we're going to run through a quick example on the next slide here to show you how easy it is to blow the $10 million test. We have a quick example here. Adam owns 100% of Build It Corporation, which has annual gross receipts of $5 million, as you can see on the slide. He also owns 15% of Crafty Corporation, another construction-related entity, which has average annual gross receipts of $50 million. And this is a good example of our attribution rules. For Adam's test, he would bring in the $5 million from Build It Corporation, since he owns 100%, and since he falls within the 5% and the 50% for Crafty Corporation, he would bring in his pro rata share, or 15% of the $50 million of annual gross construction receipts of Crafty Corporation, which would bring him to $12.5 million, which is clearly above the $10 million threshold. And as a quick reminder here, for the $10 million test, it is all business income for controlled groups and common control entities, and construction-related income from attribution entities. So for these, it does not include returns and allowances. You would not include interest, dividends, rents, royalties, annuities, anything you see on the slide here, nor does it include receipts from the sale or exchange of capital assets. So if you do satisfy both prongs of these tests, Lisa, what are the different options for contract revenue recognition that you have?
That's a great question, Chris. I think what we tend to see is that there's often a misconception that Contractors, if you are considered large, you have to use PCM. If you are then small, you have to use completed contract. And this is just not true. So we want to dispel that notion and show all the different methods that you can actually use as a small contractor. If you meet both of the components of the test, any of these methods here shown, these 10 methods are applicable. You can use them. Generally, you tend to see that a contractor will have 2 to 3 different methods, one for overall method and then one for home jobs, one for long-term contracts. But you can actually have more even beyond those 3. And just quickly to go through these, some of these are pretty self-explanatory, should be fairly familiar. Cash is cash. There are some severe restrictions with the cash method, so we don't tend to see this as often. What we tend to see more is accrual. Again, these you tend to see as the overall method, but these 2, if you follow as a small contractor, you can use these as your long-term contract method. Then a hybrid, this would be your modified cash or any other method that is kind of a hybrid between cash and accrual. The next one, the accrual with deferred retainages, this is really specific to construction. What this means is you would leave the retainage payable out of your expenses until it was actually paid. And conversely, you would leave the retainage receivables out of your revenue until they were actually received. So again, this is a method that you could use overall. The next one, the completed contract method. This is the one that we tend to see primarily with the small contractors. It offers the greatest deferral for tax purposes because this one defers the recognition of a contract until it's greater than 95% complete and that the customer is actually using the property for its intended use. And that's a 2-pronged test. The completed contract, just real quickly to get a little bit into this, was initially established for home builders. The idea with completed contract was to be able to match revenues to cash intake so that the contractor could actually, the home builder can actually pay the tax associated with the revenue. So that's why the completed contract was established as that. If you choose that for your overall method as a small contractor, just know you may be adding a layer of planning and complexity because you will have to plan for the taxes that will come due once those contracts are considered complete. The next one for the exempt contract percentage completion, this is also known as the old PCM. And this essentially, it allows you to use different measurements by which to determine the percent complete. Under 460, you're required to use cost to cost. Under the exempt method, you can actually use work hours, labor hours, production completion, anything like that, anything that's a regular and consistent method by which to measure how far along the contract is actually done. The next one is the percentage completion. This one too, this is your standard under 460. This would be your cost to cost, where you're looking at your direct and indirect costs incurred for the year versus your total estimated costs over the life of the contract. And then under those, you actually have the 2 derivatives, which are the simplified cost method and the 10% method. And we're going to go into a little bit more detail on those in a minute. The last one is for it's percentage completion capitalized cost method. Typically, this we only see on residential contracts, and we'll define residential in a little bit. But what this is actually a hybrid between completed contract and percentage completion. You actually use components of both of those methods for this.
So Lisa, you're saying a contractor would not have to just pick one method. They could actually use multiple methods depending on the contract they're recording?
Yes, actually you could. There are a number of different methods that you could use for different levels within just a normal organizational structure. As this list shows, each of these points or each of these areas are a place where you could have a different method of accounting. So you could have it for your overall and short-term contracts. You could have it for your home construction contracts, residential, which we just talked about a minute ago, and I'll go into more detail on that later. The general construction, which are contracts that don't fall under home or residential. And you have the 2 of those, either estimated to be completed within 2 years or estimated to be completed more than 2 years. Now, for that last piece, the long-term contract, the general construction, estimated to be completed in more than 2 years, that one is required to use percentage completion under 460. So just know for the rest of those, if you meet the short-term construction contract exemption, you can use different methods on those. If you don't meet those tests to be considered a small contractor, then the only ones where you could have some play in would be the home, the residential, and the long-term contracts for 2 or more. Those are the 3 different methods that you would be able to use. And one of the things I will add on this too is that once you make an election, once you have a contract and you start using a method for that contract, even if you don't make a formal election, it is deemed to be an election of that contract or of that method. So in order to change between these methods or among these methods, you will actually have to file 3115. Now with 3115, this is a form you file with your return. There are 2 different kinds of changes in methods that you can do. There's automatic and non-automatic. If it's an automatic change, then there's no fee associated with it. You file the form, you show what the difference in the accounting methods, what the difference in your income or expense would be. With the non-automatic, there's actually a fee associated with it. And I think the last time I looked, it was $7,000 to do that. So anytime if you are looking at these different methods and considering these different methods, which now is a really good time to do it given the environment, just make sure that the benefits that you would be receiving from those methods actually offsets the cost of making the change. And I will add on this too, that for the methods of accounting that we covered, one of the things that we don't go into is AMT. And AMT is still required on a lot of the contracts that we listed in the previous slide. So what happens if you don't meet the tests for the small contractor exception? What happens if you are indeed a large contractor or deemed to be a large contractor? Well, under 460, you're required to use the percentage of completion method. And it actually defines what method you have to use in this. And this, again, is the cost to cost. And what this is that you have to consider indirect costs and direct costs as a component of total estimated cost for the contract to determine what percent complete you are in the contract. And this will determine how much revenue you recognize and how much gross profit you recognize. Now, under the cost-to-cost method of PCM, there are 2 derivatives again. You have the simplified cost and you have the 10% method. The simplified cost is an election you can make, and again, by electing this, you're electing a method. What this indicates is that it reduces the number of indirect costs that have to be allocated. Under percentage completion, under the cost-to-cost method, one of the things the code actually indicates is that in addition to direct costs and indirect costs, it specifies a listing of indirect costs that you actually have to allocate to the jobs. Now, I have seen this along the spectrum. I've seen places where no indirect costs are actually allocated to the contracts. In that case, I think it's incredibly aggressive. And I don't see how, as a company, they're turning a profit. Because if you don't allocate any indirect costs, I don't know how you're accounting for estimation on contracts to be able to cover those costs overall. Then I've seen at the other end where some people recommend to allocate 100% of your G&A to the jobs. And I don't think that I think that that's incredibly conservative also. I mean, so it's along the spectrum. And the idea when you're looking at which cost to actually allocate to the jobs, the question you should ask yourself is what cost would you still incur if you had no contracts? And again, if all your WIP was gone, would you have any additional expenses? And I find it hard to believe that there would never be any expenses, that you would still have some. So under that scenario, the simplified cost-to-cost method just says the only things you have to allocate to the contracts are the direct costs, direct labor, direct material. And then out of the indirect costs, the only thing that it requires you to allocate to the jobs is depreciation. So it excludes everything else. Under the 10% method, this is similar to the completed contract in that it defers recognition of the contract until the contract is greater than 10% complete. Under the completed contract, if you remember, that was a 95% threshold that you would have to cross in order to recognize the contract. In this case, it's 10%, so it's still under percentage completion, but you elect the 10% method, and you can defer recognition on that job until it is over 10% complete. One of the things to keep in mind is that you can only choose one of those. You can either choose simplified or the 10%, but you can't choose both. And as mentioned before, here are the listing of all the indirect costs that the service actually, or under the Code Section 460, that they require for you to allocate to the contracts. As you can see, it covers pretty much everything. The only thing that I remember there being specifically excluded is advertising and lost bidding expense. And there are some other things that are excluded, but those are the things that come to mind initially. So you have all of these. Now, the way that we tackle this, and again, because the code requires this, and because there's such a spectrum going from one extreme to the other, the way that we address this is that we run a listing of all the overhead expenses that are included in the financial statements, we push this back to you as contractors. We push it back to you because you have a better idea than we would as far as how much of those expenses are actually incurred because of contracts. And then you let us know what percentage of that cost should actually be included or should actually be allocated to the jobs. A perfect example would be the officer's compensation. So say you have an officer there and 50% of his time he's working on contract-related issues. So when we see that expense, we push it back to you. You let us know that that's the case, that 50% of the time your officer is working on contract-related things. So we would take 50% of that compensation expense and allocate it to the job. Now, the key in all of this is that you should make sure that when you're allocating the indirect costs, you have to adjust your total estimated costs. And we're going to be going into some examples in a minute that kind of go into more detail what happens when this is done incorrectly. And again, this is another place that we really see a lot of things that are missed. This is something that's required by the code. It's something you should do in order to be compliant. But if you don't do it correctly, you could be accelerating revenue and accelerating gross profit for taxes, which is something you don't want to do. One of the things I am going to point out in here specifically is going to be the cost recovery. And the cost recovery line is just another word for depreciation. Now, with bonus depreciation, when this was implemented, bonus depreciation, just by the nature of it, would be accelerating depreciation expense. Given that acceleration, you would be increasing revenue. Now, the Congress, the Ways and Means, when they wrote the bonus depreciation stipulation and allowed for that extension, what they did for 13 was they actually added a provision that says that for bonus depreciation for percentage completion purposes, you actually don't have to include the bonus depreciation in your percent complete calculation. In your percent complete calculation, you only have to include regular makers depreciation. This is just regular depreciation. So that's really good. Again, because if you didn't have that provision, you would then be accelerating costs, which would increase your percent complete. And this is really interesting. If you look back to the history for bonus depreciation, the service and Congress, they haven't been consistent in this application. They provided that provision in 2010 for bonus depreciation where they said you could exclude it from your percent complete calculation, but they didn't include that provision for 11 or 12. So for 11 and 12, you have to include the bonus depreciation in your percent complete calculation. Thankfully for 13, with the 50% bonus that we have, you can exclude those costs again. Yeah. So as mentioned before, we're going to go through some examples now of what happens if you don't do the allocation of indirect costs correctly. Now here we have an example. We're going to take into consideration an estimated total contract. The revenues, we're estimating it to be $500, estimated total contract cost of $400, which means over the life of the contract we expect to earn a gross profit of $100,000. So let's say for year one, we incur cost to date of $300,000. So under our cost to cost percentage completion, without taking into consideration the indirect cost allocation, you're looking at a 75% complete rate, which means the gross profit you're going to recognize as $75,000. In the first scenario, we say, okay, what happens if you remember that you need to allocate indirect costs and you determine that $80,000 of your overhead should be allocated to the jobs. So you allocate it to your year-to-date contract costs incurred, but you don't include it in your total estimated contract costs for the life of the contract. Well, as you can see here, all of a sudden, your 75% complete just jumped to 95% complete. So for tax purposes, you're recognizing an additional $20,000 in revenue or additional $20,000 in gross profit. Now, what happens if you have those indirect costs that you're allocating to the contract? You remember to do it to your year-to-date costs, but you only include the same amount to your total estimated contract costs. And in this case, you can see the percentage complete increases by a slight amount, but you're still looking at almost $4,000 or over $4,000 in gross profit over what is recognized just under the cost to cost situation. Now, here I will say there are certain circumstances where this will apply. If you have licensure fees, you have registration fees, they really are a one-time fee for the contract. In that case, this would be true because you don't expect to incur any more over the life of the contract. But chances are, if you have overhead and you have G&A, it's actually going to be incurred over the life of the contract, so the amount should be more in your total estimated contract costs. So what happens if you do take into consideration a G&A cost or an overhead cost that is going to be incurred over the life of the contract? Well, here we provide an example of what we tend to do. Now, what we look at is that we take an estimate of how much G&A is incurred in relation to direct costs. So we say you have so much direct cost that you incur over the life, in this year, you've had this much direct costs. Your G&A has been this. So in relation, G&A and direct costs, what's that percentage? So in this case, we're saying 30%. And so that 30%, we would then increase the remaining total estimated costs on the contract by that 30% in order to capture what we're estimating your total estimated allocated indirect cost to be. Again, you can do this by any method. The surface actually doesn't provide any guidance in this. What we tend to go back to as guidance, there's a wonderful write-up put out on the IRS's website. That is the Audit Technique Guide. It's the Construction Industry Audit Technique Guide. For those of you who are glutton for punishment, I would recommend going out and looking at this. And what it goes into, it actually provides these examples are actually pulled almost verbatim from that website and from that write-up. But what they say in this case is that it's something that must be determined. So as long as you have a method that's reasonable and consistent, I think it would work. I think it would be fine. In this case, we're using G&A to direct costs to try to see the percentage of indirect costs that are incurred as a component of direct costs. And when you come up with that, as you can see in the calculation below, that it actually is going to reduce your percent complete by a small amount. So instead of having additional gross profit that's recognized in the year for tax purposes, you actually have a reduction. Again, not significant numbers, but it's better than accelerating your revenues. So now, as a large contractor, outside of the indirect costs, if you make sure that that's correct, another option that you have are home contracts. Now, home contracts are contracts where 80% of the total contract costs are attributable to improvements, restorations, buildings containing 4 or fewer dwelling units, and this is the definition for the IRS of what a home contract is. So you have that; it's anything in the building or anything attached for the real property directly related to those dwelling units. Now, one of the things that is included in this is that if you are a subcontractor and you are subcontracting work for something that meets this definition, that contract also would qualify as a home contract. So say, for example, you're a general contractor, you typically do drywall installation on commercial buildings. You happen to win a bid on a townhouse, and the townhouse is a home contract by this definition. The work that you're doing internally, the drywall that you're hanging in that townhouse would then qualify for home contract. And again, for the home contract, you can actually use completed contract. On the next slide, we go into a little bit more detail as far as what is defined by home contract and when you would have a home contract. But just know, it's not just the buildings and the real property, it's the subcontractors, anything that touches those buildings would actually get the same treatment for the home contract.
Lisa, I see you mentioned real property here directly related to the dwelling units. What happens if it's common property, such as a road in a subdevelopment?
That's an interesting question. Actually, the way the code is written, it recognizes those as qualifying for the home contract exception. But the service has actually come out and said that they won't allow it. There's been a proposed regulation, a change to this that would capture that activity as being home jobs also. Unfortunately, the IRS has come out with a special directive that says if you try to do it, they will disallow it. And this has been out back and forth since 2008. I think the intent ultimately will be to include those as home jobs, but as it currently stands, if you do any kind of real property work, like you're putting in a driveway for a house, that would qualify for a home job. If you're running a street in a subdivision, that would not. Okay, and here we show the different kind of home contracts that you could have. Spec homes, just for a real quick definition of spec homes, these are the ones that there's no construction contract. They are being built with the intent to sell. In those cases, especially when there's no contract, that is, that you're not building to a contract, these are not treated as long-term contracts. So they're not eligible for 460. you have to treat them essentially as quote unquote inventory. And the reason I say quote unquote is because they're not given the same treatment as inventory where you can write it down. You actually have to capitalize all the costs and then hold those costs until the house sells. And then at that time, then you would recognize all the costs associated with the spec homes. Now, if you have a custom home built on a builder's land, and this one you're looking at a land developer, the home builder, they own the land, they're building a house on their land. Here it shows the methods that you have to use. As a large contractor, you have to follow the spec home rules, which again doesn't treat the house as a long-term contract. As a small contractor, you have to use CCM. You don't have any other options in this regard. Now, the last one is a standard contract where you have a customer, the customer has purchased the land and then has contracted to build a home. This is the custom home. And in this case, you get a little bit more leeway for the large contractor. This is where the completed contract comes in, the accrual method comes in. You can use any of those methods to account for the home job. And again, as subcontractors, you get that same treatment as well for a large contractor. As a small contractor working on the home jobs, you can see here it's really any of your exempt methods you can use to account for the home contracts. And also, again, as a subcontractor, you would be allowed those same methods as well. And lastly, we have residential. Now, I know for just us listening to this, you would think, what's the difference between home and residential? They tend to be the same. This is the way the service has actually captured buildings that would have more than 4 dwelling units. In these cases, you're looking at apartments, you're looking at barracks, dormitories, senior living facilities, assisted living facilities, low-income housing, things like that. So in this case, when you have more than 4 dwelling units, what they try to do is give you a little bit of both. And this is the percentage completion capitalized cost method. It's a long word. The acronym's even worse. So when you're looking at this, what it says, you can split your contract into 2 components. One is the 70% of the contract you would treat as percentage completion, and you would run it on either the cost to cost, the simplified method, or the 10%, depending on which one you've elected for your long-term contracts. The second one is the 30% of the contract you would use on your exempt contract method. What we tend to see with this is usually it's used on completed contract method. And again, this seems like a lot of hassle, but if you have a large contract that does fall under this definition for residential contract, then it actually may be beneficial. Getting that 30% of that contract where you can really defer the recognition of that contract or defer the recognition of the gross profit on the contract until it's 95% complete. Again, the savings could be beneficial. And the last component for large contractor is look back. It's everybody's favorite fun word, and Chris is going to go into more detail as far as why and when and how. Chris?
Thanks, Lisa. And the look-back calculation that we're going to look at here, it's a completely hypothetical calculation in the sense that it takes what your final contract expenses are, and it says if we knew that this was going to be our total expense throughout the years covered by our long-term contract, what percentage of completion would it really have been at the end of each one of those years? And based on that, we would say what our change in gross profit would be for that year. And based on that change of gross profit, it's actually interest due to you or due to the service based on the amount of tax that you paid that year. So for instance, if you said your contract was more complete than it ultimately was, you overpaid your tax for that year because you recognized more revenue than you should have. And in that sense, the IRS actually owes you interest on the tax that you overpaid for that year that you should have paid in a subsequent year. And just to emphasize, this isn't a change in the tax that you owe. It's just the interest on the amount that you paid before you should have, or that you paid after you should have, based on your ultimate contract completion at the end of that year.
Now, Chris, I see you have listed on here specifically the 10% deferral year. Now, why is that listed separately?
That's important because if you elected the method for your long-term contract recognition that you weren't going to recognize any revenue until the year in which your contract hits 10% complete, when you do your look-back calculation, and say in the first year of your contract you calculated it was only 9.8% complete, but then based on your final contract price or contract expenses, it should have been 10.2% complete that first year. For your look-back calculation, you're going to have to realize how much revenue you should have recognized that first year, and your interest is based off of how much revenue you should have recognized the first year if it were over 10% complete based on your final contract expense. Another important thing for look back is it's only applicable to long-term contracts required to use POC. So for example, your home contracts would not apply, and anything under the small contractor contract exception, you're also not required to use lookback for. And also there's a de minimis test for the lookback calculation, and it says that your contract must be completed within 2 years of the commencement date. And it must be under a threshold of the lesser of $1 million or 1% of your annual gross receipts for the taxpayer for the previous 3 years. And if it meets both of these tests, you are not required to do a look-back calculation on that contract.
Now, Chris, you mentioned the annual gross receipts of the taxpayer for the previous 3 years. That sounds awfully familiar. Is this the same test that you used for the $10 million threshold?
This is the same test, and if you've already performed the test to see if you fall under the small contractor contract exception, you can take the gross revenues that you calculated in that test and just multiply it by 1%. And that's going to give you your threshold for your de minimis, and anything over that de minimis you will have to perform your look-back calculation on. Under the regular method for look-back, which is the method we've been looking at so far, the calculation of look-back interest affects almost all parts of the tax return, including AMT and itemized deduction limitations. The other option for calculating look-back is the Simplified Marginal Impact method, or SMIM. While this method is mandatory for domestic contracts, for non-closely held partnerships and S corporations, other entity types may elect this method. As the name suggests, this method is simpler to calculate. You recalculate the percentage of completion that should have been recognized each year, as in the previous method, and multiply the change in gross income by the highest tax rate in effect. This gives you the amount that interest should be calculated on. While this simplifies that calculation, since you don't have to take into account changes in income for AMT purposes or itemized deductions, the possible downside is that the taxpayer may not originally be in the highest bracket, and therefore may owe more interest than would be calculated under the regular method. And I wanted to end the look back here with a couple notes on how you recognize the interest. For corporations, if you owe interest based on the amount of the look back calculation, that interest can be deducted on your tax return as an interest expense, as an ordinary business expense. But for individuals, any interest you owe to the IRS based on your look-back calculation is not deductible for personal interest. However, for all taxpayers, if you receive interest from the IRS, that has to be picked up as interest income whether you're a corporation or an individual.
Now, Chris, I read somewhere that there is a greater than 70% non-compliance rate for look-back. Is there a reason why contractors should actually reconsider look-back, why they should do it other than just to be in compliance?
There is, and especially with fade jobs, if you don't perform this calculation, you're basically just leaving cash on the table because it's money that you should be getting back from the IRS that you're not asking them for, and it's not like they're going to voluntarily just hand it over to you. Furthermore, in the case where the IRS owes you interest, they will actually pay you interest on the interest they owe you based on the amount of time that they've held your money. But if you owe the IRS interest, they don't calculate underpayment penalties, estimated tax payment penalties, any of those penalties on the interest that you owe to the IRS.
Okay, and let's just recap some of the things that we covered. There was a lot of information in this webinar. First, we covered the definition of a Section 460. Again, this is the section of the code that regulates long-term contracts. The way it is defined, it gives you an absolute, and then it provides exemptions from the regulation. Keep in mind the long-term definition or definition of long-term is more than one tax period, not 12 months. And keep in mind also that if you are in the service industry, if you are doing architects, engineers, again, painting, unless it's on the original building, construction management. If you aren't physically building, improving, or rehabilitating physical property, then you are not, again, depending on how you look at it, subject to or eligible for the rules under Section 460. Now, one of the exemptions from 460 is the small contractor application. And the small contractor law, it says that if you meet the two-pronged test, which is the $10 million in gross receipts, or that the contract is less than 2 years, and that's an and test, then you don't have to follow the rules of 460. You can use any kind of method to account for your long-term contracts. Keep in mind the $10 million rule is you're looking at revenues beyond the entity itself. You have to look at if you're in a control group or if you have common ownership, you have to pull in those revenues as well. And you also are subject to the rules of attribution. If there's an ownership less than 50 but more than 5, then you have to pull in those construction-related receipts into your calculation to determine if you're over the 10 million rule. Now, one of the reasons the service did this was so that large contractors couldn't diversify their interests and move contracts into, say, like joint ventures, and then have them fall under the $10 million revenue test, and then put them on completed contract and defer that revenue recognition until it was greater than 95% complete. This is the way that they stopped that from happening. So if you do meet the $10 million threshold and you have contracts that are under the 2-year time frame, then again, we want to dispel the common notion that you have to use completed contract. That's just not true. You have, again, the last count, there were 10 different methods by which you could use to account for your long-term contracts, home contracts, residential contracts, depending on what they are. Keep in mind, the first time you encounter that contract, you use a method to account for it, you are indirectly electing a method. So once you account for that contract, in that way, it's deemed an election. The only way you can get out of that and change to another method would be by filing a 3115, change in method. Again, you got the 2 buckets that those change in methods fall in. It's either automatic or non-automatic. If it is an automatic change, then there is no fee involved. The non-automatic changes, there's a fee. And again, the last time I looked, I think it was $7,000. So make sure you're looking at these methods. Now is the time to do it, given the environment, the tax environment. Make sure you're on the best accounting choice possible, and make sure before just going that route that you're looking at the cost to benefit analysis for the $7,000 fee. In addition, make sure you're looking at AMT, considering AMT consequences. For a lot of the applications, they say that AMT has to be continued on percentage completion, so you always have an add back under the different methods. So if you're on that verge of an AMT position, make sure you are considering that. Make sure you talk to your accountant about it. Now, as a large contractor, what can you do? Here, just to quickly summarize, you have the indirect cost allocation. If you're not doing this correctly, there's a chance you're accelerating your revenues, you're accelerating your gross profit for tax purposes, and that's something, again, you don't want to do. Make sure you are adjusting your total estimated contract costs for any kind of estimated indirect cost allocations that you expect in the future. Again, there's not really any definition as to how to do it. The service doesn't really provide any guidance on how to do it, but as long as it's consistent, it's reasonable, I think it would hold. And also keep in mind for the large contractor that the 2 contracts that you can treat on a different method other than Section 460. Those are your home jobs and your residential jobs. And any work that's done on those contracts, again, as a subcontractor, you don't have to be a home builder in order to get that contract treatment. As long as you're doing work on a home job, they'll get that treatment. But this also goes back to the small contractor indirect contract election. If you've already had a home job or you've already had a residential job and you've treated it some way, even if you've kept it on the same percentage completion application, then indirectly you have chosen a method to account for your home jobs. So in order to change the treatment on that, you'll have to do a 3115. And again, the definition between home job, residential job, the home jobs are for fewer dwelling units within a building. For residential jobs, you're looking at greater than 4. So home jobs are pretty much self-defined. You would have spec homes, which don't apply, but you would have custom homes built on builder's lot, or what is the ones that really do apply, which are the custom homes built on a customer's lot where they buy the land as well. And residential jobs, the last one for the large contractor. For residential jobs, this one you can actually do the hybrid method where it's 30% is on completed contract, 70% is on percentage completion. Again, sounds like a pain in the rear to try to do this and to account for it, but it may be beneficial. But as mentioned before, and I can't stress this enough, if you've already been treating those contracts on a method, you have elected a method. So make sure you do 3115 so the service can't come back and say, this is an invalid method because you didn't make the formal change in method.
And just a few key notes left on the look back. Remember that this calculation is completely hypothetical. You're not going back and changing any tax returns or any financial statements. It's just based on your final contract cost. Remember, there are two methods. There's a simplified method and the regular method when you file your 8697. If you are filing under the simplified method, remember that your rate is changing and it's going up to 39.6 for the top tax bracket from a 35% tax bracket. And then as a final thought, remember, if you are doing fade contracts and you are not doing look back, you are just leaving money in the IRS's hand that should be in yours.
All right. Thank you, Chris and Lisa. And we want to thank all of our listeners today for joining us again for today's webinar on mitigating taxes for contractors. We will be sticking around for a while more, so please do not head out quite yet. And we're going to answer some of your questions that have come in.
All right, thanks again for sticking with us this long. We do have a couple questions that came in. First one is, are there any special rules for filing the Form 8697?
There are. That's a good question. Actually, the two rules I can think of is for the 8697, if you're in a situation where you have to pay tax versus if you're getting a refund. Now, if you have to pay tax, for an individual side, you are going to pick up the interest, I guess I should say, not tax, because it's not additional tax, it's the interest on the hypothetical tax. But you will pick up that tax, or that interest, sorry, you'll pick up that interest as additional tax. So it would show up on page 2 of your 1040. Similarly, for corporations, you would pick up that interest as additional tax, and it would show up on, I think it's Schedule G on the actual tax calculation side, just as an additional tax. But it really is interest. So when you make that payment to record it, it should be recorded as interest expense. Now, if you are getting back a refund, then the 8697 would actually be filed separately. So you wouldn't include it with the return. You would need to include all your attachments and everything, and there is a separate filing. And my understanding is that that separate filing can't be e-filed yet. It still has to be a paper file.
All right, the next one goes back to the change in accounting methods if you're going to change your contract revenue. And when you file the Form 3115, since you do have to pay a fee for that, can you do multiple changes on one form?
You can't. And actually, I just read somewhere that the IRS is scrutinizing the 3115s that they are receiving to make sure that taxpayers aren't trying to make multiple changes on one 3115 in order to circumvent the fee.
Okay, we have another question here. Does Pennsylvania recognize the federal percentage of completion, or is there a state-specific method that you would have to use?
And this is a really good question. For all respective purposes, the state recognizes the federal percentage of completion, the revenues that are recognized from that. There's not really any other adjustments that you have to do for state purposes, which is good because you do have so many circumstances where with a bonus depreciation, the state doesn't recognize the bonus depreciation. So you end up having to do the adjustment for the bonus depreciation versus the state method. But just know you don't have to go back through and do another percentage of completion calculation just for that depreciation method difference.
All right, we just want to thank everyone again for attending. Hopefully you learned something. Hopefully you know either a calculation you can show your clients, or if you are a construction company, you know what questions that you should be asking of your accountants. If you do have any additional questions, our email addresses are up on the final slide here. Feel free to contact us and keep an eye out for more webinars coming from us. Thanks again.
We'd like to thank you once again for joining us for this presentation presented by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thank you again and have a great day.